Hey everybody, welcome back to Getting Real with Real Estate. I'm Jason Potter with Strand Coastal Realty. A lot of you have been talking to me and writing in about mortgages. You've been hearing about a little bit of shakeup in the mortgage industry. Some of your friends and family members may be having a little bit of difficulty either qualifying for their refinance, their purchase, or maybe even making payments. So I've thought about who better to have on the show than Kris Davis of Guild Mortgage. Kris, thank you so much for being with us.
No, thanks for having me, buddy. Always a pleasure talking to you guys.
Thank you. So a lot of our clients have been coming to you. They've been going to their mortgage professionals. Tell us a little bit about what you are currently seeing in the mortgage industry. Why are so many people talking about the mortgage industry right now, Kris?
Well, we've got several factors at play, Jason. I think probably the hottest topic right now is forbearance, right? So if you want to talk a little bit about that, I think that's probably a great place to start.
What is forbearance?
Forbearance is simply a pause on your mortgage payments for a certain amount of time. So, for example, we do a 3-month forbearance. So what does that mean to the buyer or the person that has a mortgage? It's simple. Your payment stops. You don't have to make a payment for 3 months. It doesn't hurt your credit, but there are ramifications that people are not aware of. I'm seeing some kind of unethical real estate agents out there saying, hey, you can buy a house and don't have to make payments for 12 months. What that looks like on the back end, Jason, they're not telling the whole story there. So this is super important to your audience. You've got to pay it back. So depending on your servicer, who services your loan, who you're making your mortgage payment to, that person will determine what the frequency of the payback is. For example, I'm seeing some that you take a 3-month pause. On the 4th month, the whole 3 months are due plus your so you got to make 4 months of payments that 4th month. And as somebody that's struggling and out of work, they don't have the capital reserves to be able to fund that loan. So it is not just hey, you don't have to make a mortgage for 3 months. You have to repay that money either over 6 months all at once or tacked on to the end of the loan. And those vary wildly by your servicer, whoever your mortgage is with.
So you're advising, that's great information, Kris. So you're advising them either get in touch with you or their servicer. Who should they be calling?
Look on your mortgage statement, and whoever is on your mortgage statement is who you need to call. Just because we're at Guild, we're doing it one way doesn't mean they're not doing it another way. There's a lot of ambiguity there amongst servicers of how they're handling this. But I will stress just the major point of this forbearance, it's not, well, I just don't want to pay my mortgage. It needs to be a real hardship, and you need to think long and hard before you enter into this. What happens if I can't pay this money back over a certain amount of time? So that's something really, really important.
Kris, that is great information. I know it's going to answer a lot of our clients, and I'm sure a lot of our viewers' questions about really what this forbearance situation is. So coming up after the break, everybody stay with us. We're going to have Kris back on with us to answer more questions about where he sees the mortgage industry going, where are rates, more coming up after this. Hey everybody, welcome back to Getting Real with Real Estate. I'm Jason Potter, and thank you for tuning in today. I know a lot of you have been really, really keeping up with the real estate industry. What is your home value doing right now? If you are purchasing a property, wow, there's been a lot going on in the mortgage industry. So we have Kris Davis of Guild Mortgage with us. Kris, thanks again for being with us so much today and giving us this great information. Thank you.
My pleasure.
If somebody is considering purchasing a home right now, or even refinancing, they're looking to qualify to borrow debt, right? They get a mortgage. I've heard a lot of different things from a lot of different lenders about credit scores. I hear that a lot of these investors and these banks are changing up. Can you talk a little bit about requirements, loan requirements?
Sure. I don't want to get too technical. We got a little bit of time, but basically there are 2 factors at play. Number one, there's a liquidity in the market. So when the market took a big tank about a week and a half ago, we saw hedge funds, a lot of people having to sell treasuries, typically the safest place, right? Mortgage-backed securities, treasuries, to be able to make margin calls. So that basically took all the liquidity out of the market. So lenders couldn't sell their mortgages on the secondary market. So that scared everybody. The second thing that's at play here, of course, is COVID-19, right? The skyrocketing unemployment rate we had. So a lot of lenders are really concerned about their people's ability to repay or furlough or job losses. So with that comes some discretion from the lender that basically raises credit requirements. So for example, at Guild, we were at 580 for government loans. We took it up to 600. Here's the problem. I've seen some lenders, Chase just announced on Sunday, 700 minimum credit score, 20% down. So
really, wow.
Yeah, it scares the market though, because they think, gosh, Chase is so big, I guess everybody's like that. That's not true. That's the great news in all of this is
Good.
We're still doing loans. We're still qualifying good people. And the credit requirements and the down payment requirements have not shrunk as much as people thought they have. So that's great news.
That is great news. Now, is that just on the purchasing side, or is that also on the refinancing side, or is it about the same?
It's about the same. It's going to depend more on the lender than the borrower, right? So there is a way to get these deals done. The problem we're seeing out there is the lender calls and says, hey, sorry, your credit score is not good enough all of a sudden. Then the buyer goes, oh my gosh, I guess it's like that. I can't do it. The real messaging here is trusted mortgage professional, trusted realtor like you, Jason, that knows, hey, we just need to get you over to someone who can do this loan. It's not a reflection on you. It's simply a liquidity issue with that bank you're working with. There are plenty of options out there.
That's really great to hear. Great to hear. That's great information. Thank you so much. So everybody, they want to talk about rates. Before all this started, I think it was the beginning of March, everything was perfect. People were refinancing. You were in the low 3% for a 30-year fixed rate. Everything was going great. And then everything hit our borders, right? And then it got really real for everybody. So talk to me a little about the forecast of rates. What are you seeing?
Here's what's going on in the rate market. If you've got a conventional loan, a FHA, government loan, or a conventional loan, the Fed is actually buying those loans to keep the rates low. So we're still in great shape there, Jason. It's great news. The problem is there was some reporting out there that said rates are at 0%. Call your guy today. They dropped the Fed rate, the prime rate, way down, or the Fed funds rate down to basically zero, but that didn't have a darn thing to do with the mortgage rate. So it gave people a false sense of, oh, I get a 0%, 30-year loan. You don't get that, but you still get a mid-threes 30-year fixed rate, which is just fantastic. Still near historic lows. So that's really good news. We're seeing some different pricing for if you're doing a loan that's not kind of cookie cutter, if you're doing a bank statement loan or something like that. Those loans that might have either gone away or the pricing's gone way up on those simply because there's no buyers for them, because the Fed's not buying those loans.
That's great. And I would imagine you're still in the same boat as a lot of people where us real estate brokers, we will often turn to you first to see where's the market. Because if people are reaching out to you without us asking them to reach out to you, that's usually a good sign. And we've heard that a lot of people for the Myrtle Beach area are busy right now taking loan applications, getting their finances ready so that when the gates open, and they will be coming down already approved for their financing. It's just picking the best house and buying. Is that right with you guys?
That's 100% right. It's a time to get ready. But Jason, we're busy with, a lot of people are just busy doing refinances. We're super busy doing purchases. We're thinking about it. People are stuck in a home that they really wanted to be in the Myrtle Beach market. They're somewhere maybe a little colder right now. And like we see here, it's 78 degrees and what a better place to be. So people are still moving here. People are still buying. They may not be able to travel right now, but it really spurs a need to say, I want my family to be here.
That's
Because
right.
you're with your family all the time now, right? So it's just,
Right.
don't you want a better life? Don't you want to, walk around in flip flops today instead of snow boots?
That's how we're getting them. I know. And that's, it's so true that you said that. I think a lot of people are reflecting with their family and their priorities and where they want to be. And I really think the Grand Strand's going to do well. Kris, thank you so much for being with us. Always great information. Stay tuned, everybody. We got more coming up after this.
Take care.